So the assumption is that when the Fed raises rates, mortgage rates are going to go up. And we talk about it a lot at the Bank of Bennington. We talk to our customers all the time that what the Fed controls is the short end. By that I mean 3-month money, overnight money, 1-year money, 2-year, 3-year, 5-year. When you get to 10-year and 30-year fixed rate loans, the interest rate is controlled by the market, the bond market, and their take on inflation, whether we have a fear of inflation or not. So the Fed will probably raise rates December 16. We don't think that there's going to be an associated move of any significance with mortgage rates. As evidence, I would point you to December of 15. The Fed raised rates 0.25%, first time in some 7 years. And they raised rates 0.25%. We were quoting 4 1/8 on a 30-year fixed rate loan. Today we're quoting 3.5. So the Fed raised rates and mortgage rates went down. So there's proof positive it just happened. So what we're suggesting is don't be in a panic. Inflation is the driver, or fear of inflation is the driver for mortgage rates. We have no inflation. And we don't want, especially in the mortgage arena, we don't want lenders to use this Fed increase as a tactic to cause you to pay for a long-term interest rate because the Fed is raising rates. And the question right now is, should you pay money to lock in an interest rate? Well, I wouldn't pay money to buy a rate longer than our standard 45, 60-day quote. You know, don't pay up if you're building a new house. Don't pay somebody a point so they can promise you that the interest rate will not be up by more than a quarter over the day you sign. If you read one of those disclosures, your instincts will tell you to run away, and your instincts are good. I mean, it's crazy if you read what they ask you to sign. So we're saying don't be paying for those long-term locks, because at least in the last couple of years, it would not have been money well spent. The best way to double your money is fold it in half, put it in your pocket. Don't give it to a lender. That's our point here at the Bank of Bennington. Pay as you go. If you look what if you followed our advice for the last 8 years and you refinance your mortgage as rates come down and you haven't taken any money out of your pocket to do that, you've been exceptionally well served. If you went to the big box lenders and you refinanced 3 times, you've got somewhere between $7,500 and $9,000 either out of your pocket or added to your mortgage. So should you do business with them or should you do business with us? It's just that stark a comparison. The Fed's going to raise rates in December. You can look at that as a positive thing because they're thinking the economy's recovered sufficiently to carry these higher interest rates. But there's not an associated fear of inflation, which is the driver for mortgage rates. So the fact of the matter is it's good news. They think the economy is better. We don't see a significant impact with mortgage rates because we don't see inflation. And so at the end of the day, you're going to hear an awful lot about rates going up. And we're not making a case rates are going to go lower, so I'm not saying to you wait. I'm saying to you don't get caught up in the fear. Don't make a bad decision based on emotion. Talk it through with us. We'll explain the scenario. And anyways, we're just trying to put good information out there so you can make a good informed decision.